Most first-time buyers start their search by typing a maximum purchase price into a listing website. But hunting for homes by filtering the headline price alone will lead you into two completely different realities. You can find two homes listed at exactly $300,000, side by side, and one of them will carry a monthly financial burden hundreds of dollars higher than the other. While the listing price looks identical on paper, the background variables are wildly different. One home carries cheaper insurance and zero association fees. The other sits in a flood zone, requires expensive mitigation, and belongs to an aggressive HOA. The sticker price is merely the starting point. When you judge affordability by that number alone, you're making a major financial decision based on less than half of the relevant data. The standard real estate industry formula for monthly payments is PITI: principal, interest, taxes, and insurance. It's a decent baseline, but it frequently underestimates the actual ownership cost for modern first-time buyers. To see true affordability, we add mortgage insurance, homeowners association dues, and mandatory flood insurance to the equation. These localized, hidden weights stack onto the baseline principal and interest, rapidly inflating the actual cash you must hand over every 30 days. True affordability remains hidden until you audit these localized costs on a property-by-property basis. The cost of borrowing the money to buy the house actually pulls a much heavier lever than the raw purchase price itself. We use a rough guideline called the $6 rule. Dropping a purchase price by $1,000 only lowers your monthly payment by about $6. Fight for a $10,000 price cut, and you save roughly $60 a month. Take that exact same $10,000, structure it as a seller credit, and use it to permanently buy down your interest rate. The monthly savings multiply, immediately relieving the pressure on your budget. Strong negotiation engineers a better loan structure. It focuses on payment mechanics rather than chasing the superficial victory of a lower headline price. Property taxes carry their own trap. The current tax figure you see on a listing portal is usually the previous owner's protected homesteaded rate. It is a dangerously misleading baseline for your budget. Look at this payment bar. The moment the property changes hands or new construction is officially completed, the county triggers a reassessment based on your new, higher purchase price. Your first year in the home feels perfectly comfortable. Then year 2 arrives, the new tax bill hits your escrow account, and your monthly obligation spikes by hundreds of dollars. This is what we call payment shock. Planners actively forecast what the taxes will become. Shoppers blindly trust the seller's current tax bill and risk being priced out of their own home by the second year. In high-risk markets like Florida, homeowners insurance completely dictates whether a real estate transaction survives to closing day. A standard home inspection identifies cosmetic flaws or minor maintenance needs, but insurance underwriters require specialized 4-point and wind mitigation reports. Those reports isolate the roof, the electrical wiring, the plumbing lines, and the HVAC system. If those 4 systems are aging or out of code, carriers will simply refuse to write a policy. A property isn't buyable until insurance numbers are verified and locked in by a professional. Mortgage insurance is often viewed as a financial penalty. It's better understood as the calculated cost of utilizing bank leverage to enter the housing market today, rather than waiting a decade to save a 20% down payment. While HOA dues fund common area maintenance, the underlying documents function as a binding legal rulebook attached directly to the property deed. If you ever intend to move out and convert your first home into an income-producing rental, a single line in those bylaws can completely prohibit your exit strategy. Every added fee and community rule must be evaluated against how you actually plan to build wealth over your lifetime. Plugging numbers into an online mortgage calculator is like using a flashlight in the woods. It gives you a rough, narrow guess. A mortgage planner provides the actual map. True readiness requires looking past digital estimates. You have to calculate your exact cash needed to close and match it against a monthly payment that leaves room for you to safely live your life. The goal of real estate is not maxing out your lender's approval limit. It's acquiring a property you can comfortably hold long enough for appreciation to do the heavy lifting. Payment is the reality. Stop shopping the headline price and start charting a real roadmap.